For a long time, owning rental property in the UK was marketed as the safest path to wealth, more reliable than pensions, more tangible than shares. A simple formula: borrow cheaply, rent it out, and watch values rise over time. For nearly 2 decades, that story worked well enough that people stopped questioning it. Mortgage brokers pushed it, banks incentivized it, seminars sold it. Even governments quietly relied on it to house millions without spending public money. Low interest rates made everything look easy. 5-year fixes below 3% became normal. In many cases, rent covered the mortgage, the tax, and still left surplus cash. The risks felt distant, the assumptions felt permanent. But that era is over, and the consequences are now unfolding faster than most people expected. What we're watching is not a slowdown, it's not a temporary dip, it's not a reset that bounces back next year. It's a structural failure of the small landlord buy-to-let model, and it's happening because several forces collided at the same time. First came the tax changes, not all at once, quietly, incrementally. Mortgage interest relief was phased out and replaced with a flat credit. On paper, it sounded technical. In practice, it flipped profitability upside down. A landlord with a £280,000 loan at today's rates might now pay over £17,000 a year in interest. That cost still leaves their bank account, but it no longer leaves their tax calculation. They pay income tax on revenue they never actually keep. For higher rate taxpayers, the arithmetic stopped working entirely. Profit turned into loss without rents ever falling. Then interest rates surged, not gently, violently. Between 2021 and 2024, average buy-to-let mortgage rates more than doubled, some tripled. 5-year fixes expired, tracker mortgages bit immediately. Monthly payments jumped by hundreds, sometimes thousands, overnight. Rents did rise, but nowhere near fast enough to keep pace. Tenants hit affordability ceilings long before landlords regained margin. Wages lagged, energy bills surged, council tax climbed. Landlords absorbed the difference until they couldn't. At the same time, regulation tightened from every angle. Licensing schemes expanded across local authorities. Electrical safety checks became mandatory. Gas certification remained non-negotiable. Right to rent enforcement increased. Deposit compliance became less forgiving. None of these rules are unreasonable in isolation, but together they changed the job completely. What was once passive income turned into active risk management, paperwork, inspections, fees, penalties for mistakes. Then came uncertainty around possession. The long-promised overhaul of tenancy law shifted the balance of control decisively. Possession became slower, more conditional, more expensive. In some courts, possession cases now routinely exceed a year from first notice to resolution. In the meantime, mortgage payments continue, insurance continues, service charges continue. Rental income doesn't always continue. Arrears climbed sharply during the cost of living squeeze. In some regions, more than 1 in 5 private tenants fell behind at least once last year. For landlords carrying debt, a non-paying tenant is not an inconvenience, it's existential. This is where psychology changed. For years, landlords tolerated inconvenience because prices kept rising. Capital growth covered mistakes, covered voids, covered poor yields. But once prices stopped rising, patience evaporated. And prices didn't just stall. In many rental-heavy postcodes, they started falling. Not uniformly, not nationally overnight, but decisively in the segments dominated by leveraged investors. 2-bed flats, ex-local authority stock, new-build investor units from the mid-2010s. Exactly the homes most exposed to rising rates. At that point, landlords faced a new reality. They weren't earning income, they weren't gaining equity, they were subsidizing tenants while watching values slide. So they made a rational decision. They tried to exit. That's where the next problem emerged. Everyone tried to exit at the same time. Buy-to-let mortgage approvals have collapsed compared to pre-pandemic norms. Many lenders quietly withdrew products. Others tightened stress tests beyond practical reach. Yields that once looked acceptable now fail even optimistic affordability models. When borrowing costs exceed achievable rental returns, the deal is dead before it starts. Cash buyers didn't rush in to save the market. They waited. They understood leverage was unwinding. They understood motivated sellers were multiplying. Why pay today's price when next quarter's is likely lower? Estate agents across cities like Nottingham, Stoke, Hull and parts of Greater Glasgow report the same pattern. Listings rising, viewings thin, completed sales rare. Decent properties, livable areas, no obvious flaws, just no appetite. This isn't about quality, it's about structure. The traditional buyer base for rental property has vanished. Middle-income investors once relied on moderate leverage and steady rents to supplement retirement. Those people have watched the last 3 years closely. They've seen tax erosion, regulatory drag, political hostility, judicial delay. They've concluded, sensibly, that the risk-reward trade-off no longer makes sense. Recent landlord surveys suggest a historically high proportion intend to sell within the next year. At the same time, transaction data shows investment property purchases near record lows. Supply rising, demand evaporating. That's not a slowdown, that's a vacuum. In some regions, price discovery is already brutal. In parts of South Yorkshire and North Lincolnshire, sellers are accepting reductions of 25 to 35% from peak comparables. In pockets of coastal Wales, investor flats are changing hands below 2014 prices. These aren't distressed buildings, they're distressed balance sheets. Even areas once considered insulated are cracking. Outer London boroughs with high concentrations of rented flats are seeing investors exit in clusters. When several near-identical properties hit the same block at once, prices reset quickly. Portfolio sales amplify this effect. When a landlord offloads 10 or 20 properties together, the discount becomes the benchmark. Future valuations follow it down. Meanwhile, arrears continue to rise. Landlords in difficulty don't upgrade kitchens. They don't proactively replace boilers. They don't redecorate. Maintenance slows. Standards slip. Not out of malice, out of cash flow reality. Here's a critical insight many miss. When landlords cannot sell easily and cannot hold comfortably, default becomes inevitable. Buy-to-let arrears have risen far faster than owner-occupier arrears. The reason is simple. Homeowners cut everything else to save their home. Landlords treat property as an investment. When the investment fails, they walk. Lenders know this, quietly. The UK banking system holds hundreds of billions in exposure to rental property, most of it assumed stable, yielding, low risk. That assumption is now questionable. But banks face their own dilemma. Aggressive repossession would flood the market. Flooding the market would accelerate price falls. Falling prices would deepen losses on their own loan books. So lenders extend, restructure, switch terms. They buy time. This strategy worked temporarily after 2009, but the backdrop now is different. Interest rates are not falling back to zero. Public finances are stretched. Political tolerance for bailouts is minimal, which means losses cannot be hidden forever. The knock-on effects extend beyond landlords themselves. Chains involving investor sales now stall. Developers targeting rental investors struggle to shift stock. Trades reliant on small-scale refurbishment see demand dry up. Housing liquidity declines across the system. The next pressure point is energy efficiency. Upcoming standards will render a significant portion of existing rental stock non-compliant without major investment. For properties built before the 1990s, upgrades can run well into 5 figures: insulation, windows, heating systems. Many landlords simply don't have the capital, and lenders are reluctant to advance more against falling collateral, so those properties are listed instead. But buyers discount not just the cost of works, they discount regulatory risk, void risk, future rule changes. Prices fall further than the upgrade cost alone would justify. This creates a negative feedback loop. Lower prices reduce equity. Reduced equity limits borrowing. Limited borrowing prevents upgrades. Non-compliance forces sale, and round it goes. Now, consider the contradiction at the heart of policy. The UK already faces a housing shortage. Social housing supply is insufficient. Waiting lists stretch decades in some areas. The private rented sector fills that gap. But policy has systematically discouraged participation without replacing the function. As landlords exit, rental supply shrinks. That doesn't lower rents, it raises them. Tenants compete harder for fewer homes. Bidding wars become normal. Upfront payments increase. Some households are pushed out entirely. A less discussed consequence is who remains in the market. Professional, compliance-focused landlords are disproportionately leaving. Those with scale, systems, and patience. What remains are operators already comfortable bending rules. The very behaviour regulation aimed to eliminate becomes more concentrated. Illegal evictions have risen sharply, so have informal arrangements, so have properties quietly slipping into disrepair. None of this benefits tenants in the long run. At the same time, larger capital watches carefully. Institutions with low leverage and long horizons are not panicking, they're waiting. They don't need yields today, they need scale tomorrow. When prices dislocate enough, they'll step in. Not street by street, portfolio by portfolio. This transition is already visible in limited form. Corporate landlords acquire blocks, entire developments. Formerly dispersed stock becomes concentrated ownership. Rents don't fall in that world, they stabilise high. Small landlords disappear. Tenants face fewer choices. Government influence diminishes further. Politically, this is deeply uncomfortable. Supporting landlords is unpopular. Letting the sector collapse is dangerous. There is no easy intervention that doesn't carry consequences. So for now, the response is inertia, delay, consultation, incremental adjustment. But markets move faster than committees. This isn't a call for panic, it's a call for clarity. The buy-to-let model that defined the last 40 years is ending, not because property stopped being useful, but because the numbers no longer work under current rules. What replaces it will look very different, and the transition will not be smooth. Zooming out, what matters most now is sequence, not whether prices fall, but how the fall propagates. Property markets don't move like stock charts. They move in waves, triggered by behaviour. The first wave is already visible. Individual landlords under pressure accept discounts just to stop the bleeding. 10% below asking becomes 20, 20 becomes 30. These sales don't dominate headlines. They happen quietly, but they reset comparable values. Every valuation thereafter references a lower anchor. The second wave follows quickly. Portfolio landlords react not to losses, but to trajectory. When you own 10 or 20 properties, a small monthly loss becomes catastrophic at scale. Even modest arrears multiply. Void periods compound. At that point, rational actors don't optimize, they de-risk. Entire portfolios are offered at once. Buyers demand bulk discounts. 20% becomes the starting point. Local markets absorb shocks unevenly. A single large exit can reprice a whole postcode.
The third wave is where institutions enter the frame, not as saviors, as accelerants. Once defaults breach tolerance thresholds, lenders act, not dramatically, incrementally. Receivers appointed, assets listed, no emotional attachment. Repossession sales don't chase peak value, they chase liquidity. This is when forced transactions overwhelm voluntary ones. Price becomes whatever clears. The fourth wave is psychological. Buyers stop negotiating gently. They test limits. Offers arrive 40% below asking, then 50%. Not because buyers are cruel, but because the power balance has shifted. When sellers outnumber buyers by orders of magnitude, price discipline vanishes. The fifth wave spreads beyond rentals. Once distressed investor stock trades cheaply, owner-occupiers question everything. Why pay full price for a house next door when a similar one sells for far less? Sentiment shifts, liquidity drains, the repricing broadens. This isn't theoretical, it's how every leveraged asset unwind behaves. What differs is geography. Different regions are breaking in different ways. In parts of the Northeast, yields once masked structural fragility. Low entry prices attracted heavily leveraged investors. Small rate moves now destroy coverage ratios. Negative equity is no longer rare, it's common. Some landlords don't sell, they abandon. Keys handed back, losses crystallized. In Wales, regulatory intensity has altered incentives sharply. Compliance costs rose faster than rents. Smaller landlords simply opted out. In some towns, rental listings overwhelm sales portals. Buyers vanish entirely. The Midland sits in a fragile middle ground, still liquid, still transacting, but margins are razor thin. Any further rate pressure tips many into loss.
London tells a more complex story. Prime central areas remain a separate ecosystem. International capital, low leverage, different motivations. But beyond inner zones, dynamics resemble the rest of the country. Outer boroughs built around investor demand now face oversupply. Blocks with identical layouts flood listings simultaneously. When differentiation disappears, price falls fastest. Now look ahead. The next 12 to 18 months matter more than the previous 5 years combined. Large volumes of fixed-rate mortgages reset, not gradually, in clusters. Rates won't return to ultra-low levels quickly enough to cushion that transition. At the same time, regulatory deadlines approach. Energy standards, licensing expansions, compliance enforcement. Each one nudges marginal landlords closer to the exit. The combined effect is acceleration. Importantly, this doesn't require recession. It doesn't require unemployment spikes. It only requires arithmetic to remain unfavourable. That's the uncomfortable truth. Even with stable employment and modest growth, buy-to-let fails if yields don't clear costs, and currently, in most regions, they don't. Now consider tenants. Short-term narratives suggest landlord pain equals tenant gain. That framing is misleading. When landlords sell to owner-occupiers, a rental disappears. That household doesn't vanish. They enter a tighter market. Competition increases. Rents rise, even as property prices fall. This divergence confuses many observers, but it's entirely consistent. Asset prices respond to capital flows. Rents respond to scarcity. A shrinking rental pool with steady demand produces higher rents, not lower. Another overlooked effect is maintenance degradation. Landlords under stress delay non-essential works, then essential ones. Housing quality declines before supply recovers. Local authorities struggle to enforce standards at scale. Resources are limited. Bad actors slip through. Ironically, the compliance burden removes those most inclined to comply.
Meanwhile, banks tread carefully. They understand exposure concentration, they understand correlation risk, but acknowledging it publicly would spook markets, so they extend, restructure, offer forbearance. This buys time, it doesn't fix solvency. The longer prices drift down, the thinner buffers become. Eventually, losses surface.
At that point, policymakers face unpalatable choices: intervene directly and risk political backlash, do nothing and risk social fallout. Neither option is clean. Some propose state acquisition of distressed stock, large-scale public renting. In theory, it stabilizes supply. In practice, it requires capital the state doesn't have. Others advocate letting the market clear fully, accept the pain, rebuild later. That path risks years of disruption. What's clear is that indecision worsens outcomes. Slow collapses cause more damage than sharp resets. For small landlords still holding on, the decision window narrows. Waiting for recovery assumes conditions that no longer exist: lower rates, looser regulation, favorable tax treatment. None appear imminent. For tenants, preparation matters. Security of tenure is weaker in distressed systems, not stronger. Backup plans matter more than optimism. For buyers with liquidity, patience is rewarded, but selectivity matters. Not all property will fall equally. Not all locations recover at the same pace. For policymakers, the lesson is sobering. Housing systems cannot be dismantled without replacements. Markets adapt faster than legislation anticipates. The era of the amateur landlord is ending, not because people failed, but because conditions changed. What emerges next will likely be more consolidated, more institutional, more expensive for renters. That outcome was avoidable, but avoidance required foresight. Now the task is damage control. This is not the end of property ownership. It's the end of a specific model that dominated from the late 1990s onward, a model built on cheap debt, light regulation, rising prices. Remove those pillars and the structure collapses. What replaces it will define the next generation of housing outcomes. The transition won't be comfortable, but understanding it is the first step toward navigating it. The worst mistake now is denial.